Welcome back. Today I want to dig into the dual market strategy, specifically why we've chosen Dallas-Fort Worth and Orlando as a paired investment focus and what the combination delivers that either market alone can't. The starting point for understanding the dual market rationale is risk reduction through non-correlation. DFW and Orlando are both great aviation infrastructure markets, but they're great for different reasons, driven by different economic sectors and exposed to different local risk factors. That non-correlation is valuable. Let's walk through the demand driver comparison. What's driving DFW demand versus what's driving Orlando demand? DFW is primarily a corporate headquarters and energy market. The demand there is driven by the C-suites of Fortune 500 companies, the financial services industry, the energy sector, and the corporate relocation wave we talked about in episode 18. These are organizations with established professional flight departments that operate on predictable year-round schedules tied to business cycles. Orlando's demand is more diversified. You have the defense and aerospace layer, which operates on government contract cycles. You have the tourism and entertainment layer, which operates on leisure and corporate hospitality cycles. And you have a growing tech and healthcare layer. None of those three Orlando demand streams are strongly correlated with the DFW corporate headquarters demand. So in a scenario where Texas energy prices create headwinds for the energy sector, DFW aviation demand might soften somewhat, where Orlando's defense and tourism demand would be largely unaffected, and vice versa. If there's a disruption in tourism travel, it hits Orlando more than DFW. The demand drivers don't move together, and that means the combined portfolio has a smoother return profile than either market in isolation. You're not fully dependent on any single economic sector or any single geographic risk. That's the diversification benefit. What about the investment type mix? DFW versus Orlando in terms of what they're actually doing with capital, they're complementary there too. DFW is primarily an acquisition optimization market, finding existing FBO and hangar operations, acquiring them at regional valuations, and upgrading them to institutional quality. That's a shorter deployment timeline because you're working with existing operations rather than building from scratch. Orlando has more greenfield development opportunity, particularly at Kissimmee and Sanford, where land is available for new Class A construction. Greenfield takes longer and requires more upfront capital, but you're also setting the product standard from the ground up. When you combine the two, you get a portfolio with some positions generating income sooner through acquisitions and other positions creating value over a longer arc through development. And the exit? Is the exit strategy the same in both markets? The likely buyers are similar. The large institutional FBO platforms and infrastructure funds looking to expand their geographic coverage. But a combined DFW Orlando platform is actually more attractive to a strategic acquirer than either market individually, because it demonstrates operational capability across multiple geographies and multiple asset types. A buyer who wants to add southeastern coverage and sees a well-run Orlando operation alongside a proven DFW presence is going to value that combination at a premium to either component separately. The cross-market credibility amplifies the exit multiple. That's the dual market strategy in its essence. Two great markets that are great in different ways, that reduce each other's risks, and that create a combined platform more valuable than the sum of its parts. It's a structure we're deliberately building toward, and it's a thesis we believe will generate exceptional returns for the LPs who join us at the beginning of this journey.